So thank you, Kim. That was awesome, as is mHUB. As she said, I work for Equity Group Investments, which is the private equity firm that Sam Zell started more than 50 years ago. And I've been there for 34 years, so almost my entire career. I am so excited to be here with Suzanne. I've known Suzanne for about 10 years now and have just watched her career go like this. She's amazing. She's the founder and managing partner of Kinzie Capital here in Chicago. She launched Kinzie in 2017 because she was hoping to employ technology to improve potential investments in manufacturing. Before starting Kinzie, she had a 25-year career in finance where she had roles at Versa, CIT, and LaSalle Bank. And I'm just really excited to hear more about your career and to hear your insights that you have for entrepreneurs who are creating businesses that hopefully one day you'll invest in. So, are you on there?
Can you hear me? Okay, there
Great.
we go. Yeah. Well, thank you. I'm so happy to be here, actually, and it was interesting because we were just talking. I have not been to the new facilities, but we were just talking about how when mHUB was just an idea, and then it turned into the old, I guess, the facility in Goose Island, right? And then just now having this own standalone location. So I'm really excited to actually kind of look around and be here, and the energy and how much is developed here has been amazing, and the statistics around how much mHUB has done to facilitate entrepreneurship and really growth in our economy is fabulous.
It is fascinating, and not to plug mHUB one more time, but try to come here during like a work day and see all of the amazing entrepreneurs that are creating stuff. It's really impressive. It was impressive in the last facility, but in this facility, it's fantastic. So I gave a quick outline of your career. What would be awesome is if you could just actually walk us through your career and how you ended up founding your own firm.
Sure. So maybe it goes a little bit even, before that. My parents immigrated to the United States and here in Chicago. So I actually grew up in the city, on the north side until I was about 10, and then we moved up to the suburbs. My father was an engineer. Because of language barriers, I think he realized he was not going to get promoted and borrowed money from friends and opened a small business really in Cicero, Illinois. That's where we started. And he started with a deli. He kind of bought more delis, and then there was dry cleaners, and then he owned a bunch of pay telephones, which is how I know Sam Zell from the Duval days. And so I think, at the core, I grew up in an entrepreneurial home. And he passed away, unfortunately, when I was young. And when we moved up to the North, we moved up actually to the North Shore because of the schools. I grew up with my Asian tiger mom who decided that we all needed to be focused on education, and which was a great, was probably the biggest gift that she was really able to give us. And the exposure that I got I went to New Trier High School, and my friends' families that were all in business. And so I knew I was going to do something in business. So I graduated. I went through a analyst program at ABN AMRO, then LaSalle Bank, and also at EY, which is now EY. I was Ernst & Young back then, so I have to correct myself. And along the way, I found, even within the banks and these large institutions I worked for, I really found myself attracted to middle market businesses and products that were kind of new and different, which is also how Sam built his career on, assets that were not necessarily always desirable, but really making them better, And so that's what really drew me to eventually private equity. I then was in New York for a little over a decade and was with a private equity firm on the East Coast. I'm originally from Chicago, and my heart really was always here. And I was getting ready to have a family, and I was about to have my first child, and so we moved back here while I commuted to New York City for another 7 years. And my career really took off on the East Coast, but I just felt like I had one foot in and one foot out of Chicago with my children growing up here. I now have 3 boys, and 4, including my husband. But that's what really drew me, I think, back to Chicago and really looking at the landscape and seeing where the opportunity set was. So I knew I wanted, I had kind of an entrepreneurial itch always. I think I always knew I wanted potentially to run my own show or start a company. My skill set was in investing in finance, and I really looked at the landscape and saw a gap, I would say, in the lower middle market in terms of having very sophisticated investors that could really invest in the lower middle market and bring what I would call enterprise or large scale business know-how and expertise to the lower middle market. So it was those things, and then ultimately the last reason, and really digging deep on how I started Kinzie, was I really just wanted to control my own destiny at the end of the day, and that's, I took a really big leap, to do that.
There was so much in there, but I'm going to just stick with that little last piece because it is pretty daring to actually establish your own firm. And how many sleepless nights before you actually pulled the trigger? How did you raise money? Not ever having raised a fund, not ever having done it on your own. It'd be great to hear a little bit more about that.
Sometimes ignorance is bliss when you when you start something, but I actually knew it was going to be very hard, and there are a lot of people I worked with, even going back 25 plus years, from my analyst class, that would say, I'm not surprised she started, went off on her own, because I was always thinking about, I think for me, I actually went to my network. I went to advisors and mentors, former CEOs that I had worked with and for, others that had done this before me, and everyone told me it was almost impossible.
Yeah.
But so, you think about that, and by the way, at the time when I started the firm, and Ellen, you would know this, but in 2017, there was only one other female-founded and led buyout firm in the entire United States, and actually all of North America. So when I started the firm, I was the first female minority-founded firm in the whole country, because I think a lot of people were like, can girls really actually invest? Do they know what they're doing, right? So there was a little bit of, I knew I was kind of, I felt like I was going to be really climbing Mount Everest in many ways, but I think that's how you climb Mount Everest one step at a time. You don't do it because you think, oh, I'm going to get to Mount Everest tomorrow. You really train, and so it was it was really for me one step at a time, and my one step at a time was, what is the capital I need to actually start the firm? Where can I get that? I'm going to start with my own, convince other people to come along with me, start small. We did a couple of deals, what I would consider pre-fund, institutional fund deals. I did it by almost it was a little past the hat, but with sophisticated investors and my network, which were all people I've worked with before. I didn't have to explain my track record over and over and over again. So I did it that way. I did a couple of deals, we did 2 platform deals, acquired 2 platform deals, and between those 2 platform deals, that was about $60 million of capital I had to raise, and then after that, had great track record. Had really great results on those 2 first deals, and then we went to the institutional market, and that was a 6-year journey.
Yeah, I just like the way you say, we had 2 deals and we had to raise $60 million. That is a staggering amount of money if you've never raised money before. That's huge, and kudos to you, because that is a heck of an accomplishment. So skip forward to now. What does the portfolio look like?
So today we have done, we've done 7 acquisitions total. We have 4 platform companies, and so we've done 4 platforms, 3 add-ons, and it is divided between our 2 pre-fund, what I would consider pre-fund deals, and then 2 current platforms and an add-on that are in our first institutional fund. So we're about we're around $300 million under management today, and we've got a lot of dry powder. So we're still, actively engaged in, sourcing and looking for new companies. So that's when we went out and started Kinzie, the thesis was really, at the time in 2017, everyone was chasing like high growth deals, right? So think venture, technology, software, and healthcare. And I really dug deep on the things that I knew and I've worked in most of my career, which were companies that make things, right? So that I get that, and I've always been attracted to companies or products, like manufactured products. So we really started with a focus on manufacturing and business services. So our 2 portfolio companies, we have 2 in manufacturing and 2 in distribution, but value add, like technical distribution. So, and that's kind of where we play really well. We also have a consumer, we have a consumer vertical, but the reason we say we do consumer, like we don't do, branded consumer. If we're doing consumer, it's because we're making it. So there's a, manufactured product or a staple like associated with that, so.
It's funny that you talk about how you think about your investments. For us, we have one rule of thumb. If one of us couldn't actually step in and be CEO because it's like we don't understand it, biotech or tech, we won't buy it. So we have to be able to run it because you don't know if you're ever going to have to do that. And many of us have actually over time had to. So I get that. But it's tricky. When you're buying companies, often, you're the one that's trying to get them to pick you. How do you differentiate Kinzie? I mean, frankly, when you're going up against people like us, who've been doing it for a really long time and have huge, colleagues and staffs, and it can't be easy.
So this is where the networking is really important. So throughout my whole career, I had a very, very strong focus on making sure that I stayed close to the network, the professionals that I respected, and continuing to develop that. So at Kinzie, even though we're small, it's a couple of things. One is we were really focused on what makes the world go round. Manufacturing is one of those verticals. And how do we bring real resources where there's deficiencies within manufacturing companies when we are going to meet with them? And so I actually created a strategic partnership with a management consulting and technology implementation firm. So there are 160 people. My co-founder is actually the owner and founder of that firm. And we co-office together, so I'm able to bring, a team to the table right away. And I think for a seller, most of the time we are first-time institutional buyers for the most part. So we're either the first-time institutional capital, maybe we're the second time, but we're generally the first time where we're actually taking control of a business. So what is appealing, I think, to the sellers is because they usually have built these businesses, they care a lot about their employee base, they want to grow, but something has stifled them from growing and scaling. And it's usually technology, actually. And so I have found, and it's not because I go and meet with the CEO and management team. Why haven't you done the things? Like, what do you want to do? It's like, we want to implement an EPM or ERP. We want to do data analytics. We want to do custom application development. We have these ideas. Why haven't you done it? And it's always, we don't know how. I don't know how to resource properly with people that I know will actually pay attention to us, because the firms that pay attention to us are small teams, and they haven't really, they might have come out of big places, but they're done with the project, they leave. And the third is, it's scary, because if you are a 10 million EBITDA business, and the consultants are coming in and telling you it's $1 million investment, you've never done it before, you're just like, I know I have to do it, I'm just gonna punt it another year. And that's what happens. And so that's why I end up walking into businesses sometimes that are great businesses, they're cash flowing great, they've kind of hit a ceiling, and they're still on green screens. And it's not because they're not good operators. It's because every time it's like, oh, yeah, we've been talking about this for 7 years, 10 years, however long it was. And that's why we're still on green screens, because to change it over and not have someone in-house that can actually help us with it. So we bring that kind of resourcing to the table, and I think that really does differentiate us. Sure. And then also being able to bring operating partners who I've worked with, who I know can execute, who can jump in as a CEO if we need to. And we always bring in an outside board member outside of our own team that has actually deep industry or functional expertise within our portfolio companies.
So I'm going to do a quick aside here. I actually break out in hives if a company that we're buying has to do an ERP changeover, because when we own Schwinn, we change it over, and this is back in 1995. We turned on the first green screen, everything worked great. By the fourth green screen, we had no visibility into any of our inventory, and for 2 weeks, we literally were doing everything off of, now week-old and 2-week-old inventory. So what you do for a living still makes me a little bit nervous, so God bless you.
It actually makes me nervous, too. It's not easy to flip a system over. But I now have, we've been able to prove success that we've been able to do that and create significant efficiencies, like labor efficiencies doing it. So, and obviously our jobs as investors, like I think every day, like how am I going to create alpha against the 6,500 other firms out there I'm competing with for LP dollars? And for me, the alpha really comes from, value creation, but the exponent for me is technology. You got to have the right capital structure. You have to think about operational excellence all the time. But how do you accelerate that? Like, there's really no other way to do it today without technology and the right software.
Yeah, which also makes sense. I see now why we don't bump into you that often, because we just have a different pitch. We love founder-owned businesses, and we always say, well, we're a founder-owned business, and there's a lot of appeal when you can talk about what you face. Technology will do it, but we can't make a pitch against somebody like you. So it's really impressive. You also spend a lot of time talking about people and processes. Can you spend some time sharing your thoughts with everybody here?
Well, I think obviously process is very important. That's something we can diligence. And at the end of the day, a company, a great process, it's nothing without great people. So, we, in our jobs, like I have a small team. I have a team of 14 people. It will continue to grow, and just like you, but when you have several portfolio companies, you can't really run them, and they're going through massive changes. So you have to be able to identify the right people, and so we do go through a lot of people evaluation while we're doing due diligence. We're doing that from the minute that we're going into a management meeting, and I think chemistry is really important between a board or a private equity firm and a founder or a management team. And so we do a lot of work around that, and have made a lot of mistakes, candidly. I think that's the area where one of the statistics I just recently heard was that there is the CEO turnover for private equity-owned businesses. So turnover during the hold period, which is somewhere between 3 and 7 years, right? We say average of 5 years in private equity is about 70%. That is across the entire private equity industry. And so someone is being replaced. But then if I think about it, I'm like, oh yeah, whether it's deliberate or not, right? So that's probably the breakout is, did they identify that beforehand or not? Wow. And so most of the time, we're expecting going in that there is going to be a CEO seat change. Because usually the team that got you, and this is one of the hardest things about growing and scaling a company, and for those of you who are CEOs and founders here, and I find this too for myself as a founder, one of the hardest things to deal with is when you outgrow your own people. Because those are really, really hard decisions to make. And sometimes company even outgrows you, right?
For
So-
sure. I mean, you may not be the right owner after a while. So you spend a lot of time thinking about technology, but I always think of with manufacturing, there's usually a heavy CapEx component. Your businesses require a lot of capital. How do you think about that?
Well, there's a few things. We're obviously, that's another piece of the due diligence we're doing is what is the capital requirements if we want to continue to scale and grow, especially if you're in manufacturing. And, I was just thinking back through, just my career and how much things have changed. There's less labor involved, so less labor means better equipment. Like, you have to have better equipment, and evaluating that and what is the ROI. I mean, we do so much analysis. I'm sure you do too. I mean, I think private equity investors who are good at investing in manufacturing companies go deep on their fixed assets, on diligence and understanding what the capital requirements are going to be in order to scale. And we don't like surprises, although they happen all the time, and you kind of have to expect that too. But I think so sometimes though, it's a little bit of, if you have good equipment, you also don't always need to replace it, right? They're like one time, and it's more for expansion. So, but I actually get really excited sometimes when I go in and I'm like, oh, this equipment is really old, because it means I get to buy new equipment that is now 30 years newer, because sometimes they are like 25, 30-year-old, CNC machines, and they don't have like the laser etching that, that's available today. And also just the automation, right, the automation, and we're going to price for that, when we're acquiring a business. So CapEx doesn't scare me, but we don't do heavy CapEx businesses either. When we're getting into leasing, and I'm not as interested in that. Like, I'm more thinking about what is the end product, what do we need to make it, can we run these lines for a long time? But that's also where you can get into trouble, because I've also seen on the other side of it, companies that have great brands, have been producing the same things for a long time, are afraid to shut down their equipment and replace, and then the lines just die, right? And you can't have that either. I mean, it's just so disruptive. And I have seen that, not recently, but I had a company years ago where the decision was, well, we don't need to make that CapEx investment. It'll be fine. Like, we're just going to keep maintaining it, and it'll be fine. And the line shut down. Like, it was a big piece, and it took us 8 months to replace it.
Ooh.
And so literally EBITDA went from 25 million to 4 million that year. And we had people, it was really, really a tough. So the tough lesson to learn, but I will never make that mistake again.
So one of my questions later on was going to be about black swan events. So clearly you have one. We always joke at our firm that, everyone, does the hockey stick projection, but in the out years, nobody ever does a little downturn. But things like that happen. We used to have, our hospital company had 31 hospitals, and then Hurricane Michael came through, and we now have 30 hospitals. That's not just, it's for real. It tore down an entire hospital that we no longer have. So stuff happens, and I think that, when you think about either new entrepreneurs or investors, they just don't realize that stuff can go wrong. And at least for us, all we hope for is that we've prepared our companies with enough liquidity, and we have enough wherewithal that we can back them when that happens. I mean, we had a company that had a cyber ransom event, and it was significant dollars. You don't plan for that. So I'm sorry you guys had to face 8 months of downtime on the line.
Not currently at Kinzie, but in a previous life,
Yeah.
I had to do that. So I've learned a lot. I think that's one of the things about starting the firm. When I did, I felt it's very hard to be a good private equity investor without decades of experience.
Oh, for sure.
Right.
Speaking of decades of experience, you've been through quite a few cycles. Have you found that certain cycles have been more, provided more opportunity? Like, what happened to you during COVID? Where have you found opportunity, and
Yeah,
where
I
has your
mean,
portfolio done well?
So I have found opportunity at so I am a big believer there are great investments in good cycles and there are great investments in bad cycles, right? But you have to know like when to strike, and you can't time it. But the reality is, I mean, just in my, I was thinking about the cycles and all these, I mean, driven by black swan events. What we had Y2K, we had 9/11, we had the mortgage crisis, right, which led to the financial crisis and the Great Recession. We had COVID. I mean, I've had 4 cycles in what I consider my relatively short career of 25 years. I mean, that's a lot. And every time, fear is a funny thing. Like, it's so interesting because everyone knows the pattern, but it's always the same. People pull out. When people pull out, it's a great time to find investments because you can buy right. Half the battle of being a great, if a good investor is buying right. It's not just, the value creation, but you have to buy it right. And so some of my best deals have been when things have been down and like making sure that we're kind of not waiting, but not buying top of the market. And we all know when it's top of the market, but people are competitive, and so when everyone's in competition, I think we get carried away, and then things get really high, and then you just wait. So it does require a lot of patience, and so I think the markets. I had one of my probably most successful deals prior to Kinzie was a company that was losing money. It was part of a large public company, and it was like an orphaned business. No one was paying attention to it, and it was about $8 million negative a year. And we went in and we saw way too much labor, way too much overhead. They were going to completely shut the business down. I bought it for 20 cents on the dollar on assets. And we had it positive EBITDA within 6 months, and then so positive EBITDA within 6 months, and to 12 million of EBITDA in 18 months.
Wow.
And that was because everybody rallied around it. We had better management, like people were paying attention to it, and so that was sometimes it's when like people ignore something, like there's something there. I'm a big believer in like second chances. I love that. I love the underdog stories. So. I felt like, those, I'm sure, and I know that was also, obviously Sam was like prolific that way, but always finding things that were not necessarily popular.
Yeah.
Right?
Yeah, no, for sure. And many of us have operating experience, so we'll actually drop down and do turnarounds if we have to. Do you have your portfolios grow through organic means, or are you having them do acquisitions too?
So where we start we do acquisitions because of the size of our businesses. So we're lower middle market. I identify, and our range is 3 to 15 million of EBITDA is what we state. Our sweet spot's probably closer to like 5 to 10, right. But we've gone down as low as 3 and as high as 15. So with that size business, in order to scale, and usually we're scaling to either sell to a strategic or a larger private equity firm who might have it's a financial strategic, or someone who actually just can go global, because we're focused on US-based businesses. So we look for a couple things. One is differentiated product or service that we know is scalable with the right investment. And then acquisition opportunities. So disjointed. If it's a fragmented industry, but this company but we see an opportunity for potential consolidation, either regionally or nationally. Like that's really interesting to us. So we do both, and sometimes we're doing acquisitions just for customers. So I have a company in our portfolio today. It's the largest consumable golf products distribution company in the country. It's very small. It's a highly, highly fragmented industry. If you look, there's hundreds of little mom and pop businesses that do this because they service the golf courses. they service golf courses, and then there's retail. So we do both. And there's an age, so there's a generational shift that has been happening in the golf industry. And, with pros now changing, right, the demographics are changing in golf. And so we saw that as an opportunity. They're very good. They're like the best in the industry. The retailers love them, but so do the golf courses. And we just saw an opportunity there to not just grow organically with new product lines, but investing into people. So this one was we're going to invest into people to develop better products for the business. So we have more product capacity for our clients and customers, but also through acquisition so that we could get into the right regions. And so very small acquisitions, but we've been really active doing that. So we've been able to double EBITDA in the first 12 months.
Wow, congratulations, that's amazing. So I know there's a lot of entrepreneurs out here who want your specific insights so they can take it and become as successful as you. What would you advise, what good advice would you give some of the entrepreneurs in this room who either have a great product and haven't created a company, but one day want to be acquired by somebody like you?
Well, it's so hard to be an entrepreneur. Like I will just start with that. It is, you can hear all the stories you want. I equate it to kind of like parenthood. You can be an aunt or an uncle, and you have your best friend who has all these kids, and you're around them all the time, and it's never the same experience for any parent. Like a first-time parent, you just don't know what it's like until you do it, and it's so hard. It's so hard. It's like the hardest thing you've ever done in your life, but it's also the most rewarding thing you've ever done in your life. So, and so you just, I think being an entrepreneur, you really have to love what you're doing, because otherwise it's so hard to get up in the morning, because it's like challenges all day long, to start a business. And I think the other is, I have found generally you've got to have the right support system around you, because entrepreneurship is very lonely, but you also need like an army. It's like an army, a village, whatever it is, to support you and be there. I was really fortunate. My family was all, when I moved back to Chicago, I then had my family, my husband's family, my husband, who was like my biggest champion, also the most worried all the time, everyone around me. And, I think all those things are really important, differentiated product, service, but that relentless, just being relentless, solution focused, knowing that you're not going to climb Mount Everest all at once, and having to really take that every day. I always think, what's the one thing I can do to make it to my goal? It's like that for me was what got me, I think, through the first, candidly, 3 years. 3 years, it was 3 years of that.
Yeah, that's terrific advice. What is interesting to me is, I've seen a lot of entrepreneurs. Obviously, we sponsor a bunch of young entrepreneurs. And what I haven't been able to figure out is, when is it that you take your passion project that now looks like it's a real commercial opportunity, and how do you professionalize that? And I'm sure you've met lots of people who are at that stage. Any advice for people on that front?
Yeah, and in order to build a business, what I found is, people who have been able to start generating revenue, they had a great idea and they've been able to sell it. And if they can't sell it, they will find someone else to sell it, because they're passionate about it. And at some point you have to, and I equate that, I'm a big sports junkie, so I equate that to playing offense, right? You've got shots on goal all the time until you start shooting goals. You really cannot win the championship without a defense. So I think it's really important, even early on, to think about what your back of the house looks like.
That's great.
Right? So what is your accounting? What does your systems? Do you have someone who can hold down the fort and actually maintain operations? And investing in that is so critical. And I think that's where we see entrepreneurs even with great ideas, like make it or break it. Like they just don't think that part is important, and it is, because you cannot build a 10-story building if you have no foundation, right? Like the concrete's really important. It's not exciting, it's not flashy, nobody wants to see, no one wants to stand and sit on concrete, but you have to have that.
And if you're going to ever get institutional capital, you better have it. So let's turn to that piece. How would you advise people here to think about going to get capital? When do you get capital? How do you know how much of your company to give away? I mean, those are all questions that people like get really nervous about.
You know, every business is different,
Yeah.
right? So I'm a buyout investor. So my companies are cash flowing. There's a market for them. It's very. I would highly recommend, if you are in that range of 3 million or above in EBITDA and you're looking at bringing in capital, hiring an advisor, because that is actually really important. I tell even my best friends, like, oh, do I really need to spend all this money? I'm like, you do. You do, because you don't know what you're doing, right? Like, hire an advisor, an investment banker. You know, that I think that's also really, or talk to people, or advisory board if you have a board, or people around you that can introduce you to someone who can start thinking through those things. But like thinking, you know, and sometimes with, I think, early stage investments, it's a lot of it's based on potential revenue, right, versus cash flow and how quickly you can build. But those things too, like you really need to know what's going on in the market. You know, the market is very different today than it was even a year and a half ago in terms of venture valuations. Venture valuations are down a lot. You have to be thoughtful, right, because there's so much competing. There's a lot of down rounds right now. And so just like understanding the market dynamics of what is going on within your industry very specifically, you know, as an entrepreneur, and then also understanding what's going on in the general financial market is really critical. And then, you know, talk to people you trust and ask. I think that is a really important thing. I mean, find people in the network. I think mHUB is a great resource for things like that, right? Because mHUB, 1871, I mean, all these, they exist to help entrepreneurs really try to, you know, figure these things out. How do you raise capital? How much do you give away? You know, but at the same time, like, if you are looking for real capital and real partners, it's not going to cost you nothing. No. So you have to be realistic about it, too.
It's funny, I've been listening to you for the last 40 minutes, and the one theme that I keep pulling out is how important networks are. And you talked about networks from the beginning of your career, from when your parents were, you know, creating their ventures, you know, throughout raising money, throughout building your own business. And to me, that's an amazing theme. You know, how do people build networks?
So when I was just starting out. I'd gone through my analyst program at ABN AMRO, and I was really fortunate to have gone through a rotation at LaSalle Bank, which was actually owned by ABN AMRO. And everything at the institution, for those of you, if you know who Norm Bobbins is, he's a legend, and that was his entire mantra. Relationships are key. Like, I think culturally at the organization, we were taught that what you say you're going to do, you follow up, you shake hands, you look people in the eye, you pick up the phone, you don't do things over email and text, okay? Like, that also doesn't work. You know, you gotta like actually make time to meet with people. And so that was, and he wanted all the bankers out. Like, go play golf, go do all these things, and you think, oh, well, we were technical people. We were supposed to be modeling and doing all these things, but you couldn't get very far if you didn't show capacity for being able to build relationships. So that's the building the relationship piece, not just networking, but like building that relationship piece is really critical. And you know, I learned there were 3 ways to get to the top, like very early in my career. And one was being so technically proficient that no one wanted you on the other side of the table. Like if you left the company, like that would be really bad, right? Or they're gonna hire you because you are literally the best lawyer or the best at what you do. So that was one. The second was to be politically savvy, meaning know how to manage people up, but also know how to get people to follow you. Right, so leading, like what does that mean? Like convincing people that, you know, what you are doing like makes sense for them. So also treating people, I would say, your peers and the people who work for you with kindness, respect, and so that they follow you. And then the third was generating revenue. And all of those things require networking and building relationships. So I tell even my team, I encourage them down to, you know, our even entry, you know, our first year analysts, they're required to do or try to do 5 meaningful meetings a week. Great. And so that means 30 minutes face to face, whether it's on Zoom or coffee or something, so that they learn how to take time out of their week. And we actually have a chart. Did you do your 5 meetings? Did you not? It's like green or red. That's it. So.
I love that. Yeah, you know, it's funny because some of our junior people are always like, oh, can I go to that senior meeting with that CEO? And I keep looking, we take them, but I'm like, guys, meet people your own age. Meet people your own age now, because I'm telling you, in 20 years, they're gonna be running every firm around. And so but it's a matter of actually going and meet people like on their turf, and that's a big deal for us. We will get on a plane and go meet anybody at any time because showing up makes a difference. So,
especially now with COVID, right?
Sure, for sure.
Everyone wants to do Zoom, and you know, even the people who come to our offices who are looking for, you know, to work with us, partner with us. It does make a big difference, like if someone shows up at the office versus let's do a Zoom call.
No, it's absolutely right. Well, believe it or not, we're out of time for the formal discussion, but we have time for Q&A. So you guys have to have questions for this amazing human being.
Bunch over here.
I'll just speak into it. Hey. Yeah, good evening, Suzanne and Ellen. Let me congratulate you for building this organization. I did hear the podcast in full, and I read the article, Breaking the Bamboo Ceiling. I was very inspired, and that's why I'm here. We are trying to do something similar, having established a family office last year, and then we'll be building, scaling, and growing it up. So I wanted to hear your story and see if there were any lessons learned. I did notice something on the website, since you have broken not the glass, but the bamboo ceiling, and you do say that the participation of women and minorities is a little less in the finance sphere, mostly at the Wall Street. So curiously enough, I did go to your website, and it has 13 pictures, not 14, that I just saw. 5 are women out of the 13, that's 38% representation, if you will. Out of the 4 senior advisors, there's 1 woman, that's 33%. So those statistics are very much in line with that finance traditional space being dominated by a certain demographic and gender segment. I was just wondering, when I went there, I expected to see woman power with everyone being the replica of Suzanne Yoon. Would you attribute that to lack of interest from such segments? Not being able to access the talent that you're looking for? Look, I'm not saying that we should support any of those different things. I mean, I'm all about diversity, equity, and inclusion, but I'm also about let the best person for the job get and have the job.
So we lead always with our core values, and they are growth-oriented, relentless, innovative, team, and diverse mindset. So I purposely didn't use diversity because it does mean diversity, right? It does mean to have diversity. I'm going to address, you know, your question. There's 2 things I heard was, you know, it didn't look like it was, you know, is there an issue in the finance industry or in private equity? So I want to go specifically to private equity. The answer is yes. There are no women in private equity. I mean, Ellen is like, right, like this is why we know each other, because we stick out like sore thumbs everywhere. We all know each other, literally across the whole country. Like if we are partners, or partner level or above in private equity, everybody knows each other because yes, we all like and respect each other because we know how hard it was. And I will tell you, I get a lot of questions. What was it like being a woman on Wall Street? What was it like being a woman in private equity? And my answer is, wait, I'm a woman? And I say that like jokingly, but the reality is like we had to have blinders on and we just like worked our asses off. That's how we got to, you know, these senior levels because there were no women in my analyst class. I mean, I had 4 women in my analyst class. I was the only one that lasted 2 years of 38. Okay, because it's a very tough business to be in. So there is a pipeline issue. We see a lot of improvement in it, but a lot of that is because now there are young women, I think, that see people like me and Ellen and all the other women I know that are fantastic, like amazing investors. And, you know, I would say some of the best in the industry. And they see that there is a path to having, you know, being able to be successful, not having to take, you know, the back seat, being able to be in front. So I think more women are encouraged to do that now. It's a hard business for everybody. This is not like for a lot of people. It requires a lot of, it's very aggressive. It's long hours, and you know, it is hard. It's a hard business to have families in. So I think that's part of it too. But you know, what are we doing kind of to address that? There's a lot more focus on it today from the institutional level down because I know Ellen has been, I have been, other women that are in the same position I am across the country have been very vocal about it. The LPs are vocal about it. And when the investors care about it, and you're running a family office, when investors care about it, then the GPs care about it, right? So they make it so that it's more fair and even. So I think it will change.
Boy, that actually could be a whole hour-long conversation between the two of us for sure. I think we had one more quick question over there. Yes, I saw that lady.
And then we have 2 over here too.
Oh, okay.
Hi, this was such a great event, and thank you both so much for your insights. I'm curious, in the PE industry, we've heard earlier this week that the Fed is only going to reduce interest rates 1 time this year, as opposed to 3 times, which was originally said. It's kind of left the PE industry in like this a little bit of a holding pattern. I'm curious how much that's really influencing kind of your day-to-day activities. Is it influencing like your portfolio management? Certainly, Ellen, you've been in this space you've seen interest rates as like 8% before, so this isn't anything new, but I've heard from other people who say like, we're just waiting.
She just called me old.
I'm so sorry.
I've also seen
I'm old
Hey,
too.
it's all true. It's all true. But
No,
what's
but
funny is,
not
as you were talking about
unprecedented,
this,
so.
we were both just shaking our heads, not affecting us at all. We're still going to buy what we're going to buy, and maybe we're not going to sell any of our businesses until we know that we're going to be able to get a good price, but I don't know about you.
So the dirty secret in private equity is that everyone bought these companies, right? The last 25 years. You've got all kinds of people who look like absolute geniuses because they bought companies and then the interest rates just went down. So then how do you, it's like, how do you offset that? You offset that by having value creation strategies, not just leverage buyouts waiting for interest rates to go down and paying down debt. That's not a value creation strategy. So, Ellen's firm is like this, I'm like this, right? We're very operationally focused. And so because we're operationally focused, like that's where our value creation is coming from, not from, deleveraging, although it helps a lot. I can't wait for interest rates to come down, but that's not what is really going to drive my returns, and I'm not banking on that to drive my returns. But the other thing I would say is being in the lower middle market, particularly, you have to be very careful about leverage, right? Because if you're at 0 and you all of a sudden went to 13%, it can change things like overnight in terms of leverage ratios, fixed charge. And so this is, again, goes back to buying something right. it doesn't necessarily, it means, you know, it doesn't only mean getting it for the right price, it also means structure. So does that mean, are we gonna over-equitize a business because we really like it, because we're gonna win, because we're not gonna put the company at risk with an upside-down balance sheet, right? Or are we willing to do that, but do we have reserves to pay it down and have the right capital behind it? And so I think, you know, even if you're gonna over-leverage something up front because you think that there's gonna be a quick pay down, you probably wanna have backup. So there's a lot of structuring that has to be considered. And again, this is an experience thing. We've been through several market downturns, and you know, small company loses a couple million of EBITDA, can change that overnight. So I think there's a lot of consideration in it, but for me, we don't really think about that as today. And I think most PE firms are in the mindset of, this is where the interest rates are. We're underwriting to that for an extended period of time. I don't see firms actually underwriting a decline in interest rates. Like they're hoping for that. That's great. It's going to be upside, but that's probably not where any of us are underwriting today. There's like,
We have time
there's
for
like,
one more?
oh, like
Yeah, we do have time.
oh, okay. There's 3 right here.
Here you go.
Oh. You should pass it back after your, yeah.
Go ahead.
Oh.
Hi.
Had your hand up for a while, so that's why I
I'm
wanted to
super
make sure.
excited to
Yeah.
ask my question. My name is Joyce DePriel. I am a lifelong Chicagoan. I went to St. Ignatius College Prep in Northwestern.
That's where my kids go.
Amazing. I study manufacturing and design engineering, and I've been working as a product designer. I was formerly with Motorola Solutions and most recently with Accenture. And I'm sure many other early career professionals here might be interested in learning how to maybe move into the private equity or financial institution space without having direct experience within one. I'm very curious about that, so I'd love any advice you might have.
Can I take that one? Call me. Call me. I actually think that it's our jobs to always take phone calls for people that are looking to advance their career, help them. I mean, it's not like we're going to hire you tomorrow, but I may know people that, you know, you wouldn't otherwise have access to. And, you know, people, my network helped me all the way throughout my career, and I just believe that that's what I owe everybody. And so I volunteer. It's easy to find me on LinkedIn. Ask me the question, and, you know, always happy to help.
I appreciate it. Thank you.
So one, maybe a little like more for us, when I go back to this whole like diverse mindset, it's having people from different backgrounds who have different experience that are not necessarily like me, balance sheet junkies. Okay, because that's what I was taught, like technical balance sheet modeling. That's where I started, and investing like that way. But people on our team come from operating backgrounds, you know, but it takes a little bit longer. Some people go to business school, right, to make that career transition. And then the other is really find a private equity owned company, make it known to the private equity firm that you're very interested in kind of moving up the ranks or going into an operating, you know, an operating role or operating a portfolio ops role versus just being at that company, because a lot of PE firms are building out portfolio ops teams. And the portfolio ops teams really straddle between investments and day-to-day operations of a business, which is really a unique experience.
Hi, Suzanne. My name is Paige Fugger. I studied industrial engineering at the University of Illinois, and I founded my startup there. And I also work in construction as a sales engineer. So today I was on site at a project at Rush Hospital, and the project engineer was actually a woman who was doing the bid for the project. And there was 20 men in the room, and she said to me, right away I introduced myself, obviously, and she's like, I am so grateful that you're here right now. And she just kind of like ran down the project with me and stuck by my side, and I was like, you know, we need to get involved in a construction group for women. They're 10%. I'm not seeing them anywhere. And I think my question for you is, you know, as a female entrepreneur, I'm working on, you know, a business in manufacturing and things that involve like OSHA, and you know, a lot of people don't always take me seriously, I think, because they don't, you know my background. And how do we kind of facilitate women working together and expanding this? Because now at my company now, in 2 years, I'm going to hire a sales engineer to do the same job that I'm doing, because I do want to make it where women don't feel uncomfortable in those rooms.
No, that's, I think, so one of our companies, portfolio companies, is actually it's the largest lighting distributor and lighting and controls distributor in the country, but the largest in New York City, and we're in the construction industry. So we actually, there's a small group of women. Also, I would say construction is like the second worst industry relative for women, relative to private equity. I think private equity is probably the worst, and then construction's up there. But I think having, for us, like we were just talking about, having a network of women to be like empowered together. So there's women in construction groups I know that I've started to develop. I would find those. I think that gave me, I didn't talk about this earlier, but I'm part of a group called the Private Equity Women's Investor Network. And it was made up of some of the most senior women in private equity all over the world, including limited partners and investors that invest into private equity funds. I would not have had the courage, candidly, to do what I did and start Kinzie without the push from them. Like, they were really critical for me, and they still are, even though, the larger, network is not that way. But I just think that is actually really important, and I want to do that too. I think that's one of the reasons we keep kind of fighting through, so.
So, as investors in American manufacturing, what are your thoughts on reshoring and friendshoring, and if it's possible to de-risk supply chains from unfriendly nations when basic materials such as metals and minerals only come from certain countries?
Oh, I think it's critical. I mean, look at the geopolitical environment today. So when I started Kinzie in 2017, and I've always felt like this, we went offshore. Right now we're coming back onshore. I think, it's just some of the statistics for you in manufacturing. I think it's fourth quarter 2023 was $2.4 trillion of GDP came out of the manufacturing industry in the U.S. In 2009, it was 1.8 trillion. Just think about that movement, because everyone started thinking about offshoring. There are all these problems. Now people are coming back, and they realize, right, just-in-time inventory doesn't really work if you're buying stuff from China and it's stuck on a boat. And so, I think there's the reshoring. I'm long on reshoring because the population is growing, continuing to grow in the United States. We have, and then, you have to continue to think about. So I think it's going to continue to happen in a regulatory environment. I have a manufacturing company right now that does display manufacturing, and we are getting a lot of attention from overseas because a lot of manufacturers that, like the end user, so just think huge public companies that were manufacturing everything overseas are requiring even their overseas manufacturers to have onshore capabilities. And there's not enough. So I think it's important for the country. I think it's important for our economy to continue to onshore.
I think we have time for one more question. And I know this gentleman had his hand raised earlier.
Thank you. First of all, welcome to mHUB. I'm representing Develop Ventures. We're the only VC fund in this building. I actually met you and Sam Zell in the same room 2 years ago. God bless his soul. You're phenomenal then, and you're phenomenal now. But my question is more on giving back. You have a very good reputation around Chicago for giving back to education and kids. I want to ask again, why is it so important to give back now more than ever?
I think people are influenced by their own lives, to some extent, but My mother used to tell us when we were younger, and my father passed away when I was young, and I think we had a lot of great people around us who helped us. I went to university on a scholarship. I had a lot of great people around us, but she used to tell us that talent, God distributes talent equally, but opportunity is not. And so it was all about how do you, when you see an opportunity, go after it as hard as you can, like, right? So if someone gives you something, but you also have to create opportunity for people who don't have it. So I think that's really what drives my philanthropy and education, particularly, which is why places like mHUB are so critical. Because then for entrepreneurs, for all these people, right, because where else would you find that opportunity? So, we think about that a lot. It's like to those who, what is it, much has been given, much is expected. So I think it's really critical as you find, everyone here finds success, and even if it's a little bit, there are a lot of people who have a lot less. And so I think, exposure to education is what makes people see what is, what they might have thought was impossible is possible. So I think philanthropy is really critical in that.